We talk about all these extremes, all these superlatives that we've seen over these last 5, 6, 7 sessions here. What do you think was really driving that?
So, we've been in the camp that a lot of this was a technical unwind of, some speculator trades, whether we talk about, the yen carry trade, or we talk about a short volatility trade. I know this sounds like a lot of jargon for a lot of your audience, and it certainly does for a lot of our clients. But the reality is that while some of the macroeconomic data certainly did come in a little bit weaker than folks hoped, certainly in the labor market and for some of the manufacturing data, the reality is the U.S. economy is slowing. But nowhere near recession. And earnings, by and large, are coming in okay, consistent with a soft landing. And that's what we need to continue to focus on, is that a soft landing is just that. It is a landing. It is a material slowdown from what had been a very, very strong expansion phase.
Yeah.
We're going to avoid recession, avoid negative growth, but we're going to be below average growth. And just the path to getting there is bumpy.
Well, I hope Jay Powell is watching this, Lisa, because right now the drumbeat coming out of the markets and even from some of the other Fed members that you need to cut big, and you need to do it sooner rather than later. Here, I mean, if we are seeing effectively what is kind of the makings of a soft landing, what do you think the monetary response needs to be, if there needs to be one at all, at this moment?
We're in the camp that says the Fed has been appropriately measured. They've been appropriately data driven. As I said, the data is mixed. We got good data on services. And I think that the Fed is going to proceed with caution. They've given forward guidance. They're going to start in September. It's probably going to be 25 basis points. And that is the right thing against a backdrop where we're coming out of a second quarter where United States GDP growth on a real basis was 2.8%, which is quite healthy.
So, Lisa, Romain was talking about gold. Where do you go for safety when things are bumpy?
We like gold a lot, and we also like other real assets. So we include, in addition to gold, right now we're buying things like energy infrastructure assets. We're buying residential real estate linked assets like the residential REITs. Those are all areas that we think are relatively safe. And our favorite place to be at this point is investment grade credit. We are in the sweet spot for investment grade credit, where you're not too hot, you're not too cold, you're able to clip coupons with corporate cash flows remaining very robust.
Lisa, it's interesting you bring that up, because this week we saw record issuance in investment grade. We didn't have a blowout spread situation that would have implied a VIX at, say, 60 or 65. Do you think that is yet to come or not?
We are in the camp that there's still a lot more volatility that is probably going to play out this summer. There's just too many unknowns. There had been way too much complacency in this market. And so our best guess is that while volumes are low now, as people come back from vacation, there are still portfolios that are out of position that will continue to unwind as we get into the post-Labor Day fall period.